that is Pan-Arab, if I'm not mistaken. Prior to this, Radi was working with Zain Telecommunications. He was their marketing guru. Prior to Zain, he was one of the people that founded the Marcom, the Marketing Communications Department in Palestinian, in Paltel and Jawel as well. And before that,
too old.
he worked at companies such as Alcatel and Lucent
AT&T.
and AT&T. And you'll never guess what he studied.
Music.
No, of course not.
Why not?
Come on. خلينا نكون مع بعض. Studied physics.
Ah.
So this is yet another point that we're trying to emphasize, that it's not about the discipline that you study, it's about the discipline you apply in how you work and do things. So you go from something in terms of physics to something completely creative such as marketing, and then marketing morphs into venture capital, but I'm not even going to go any further than that. So, Radil Fasid, please.
It was actually was a funny thing, because I was at Birzeit in 2008 at the opening of the marketing department. And I did a presentation on how do we do marketing in Paltel. And then at the end, all the students were asking, so what do I need to study to become a marketing director in Paltel? I said, well, I study physics. That was really,
Yeah.
it doesn't, it's about what you like, because, you know, as a physicist, you know, I'm not the typical researcher, so I didn't like that. So I started as a software developer actually at AT&T. I didn't like that either. So, and then I thought, okay, what do I want? And then, you know, because in physics you're trying to explain difficult subjects into more explainable concepts. And that's actually what marketing is. You know, it's trying to translate, for example, a technical solution into something, a need that people have. So that's why, you know, this is how I went into marketing. Good. Today, I want to talk about financing new ventures. So basically, how do you get investment as a startup? I don't know. They got an email about the assignment, and actually, I think first I want to do a little round of introduction and also explain a bit, very short, about what your project or startup or thing is. So can I start with you?
We're done.
Sorry?
I read nothing actually.
You're a man, first of all.
Yes.
Okay.
That's a good start.
That's why I'm sitting at the first door actually.
Okay.
Just to pay attention.
Okay. All right.
I'm Majdi. I do online marketing within Safek, and my team, we're working on an online platform that sells used books. That's mainly it.
Abdullah Sabri, I'm a web developer and Minister of Transport. Currently, I work on an application for restaurants and.
Sahar Habibullah. I've studied finance in Arab American University, and I work as an assistant at Global News Agency. And we're working on an application and plus website. We call it Find a Book, which offers free textbook for limited income students. That's it.
عيسى حماير خريج بيرزيت business administration and small business development manager.
محمد عادل designer programmer
By the way, if anybody is not confident in English or whatever, I understand Arabic, I only cannot speak it. So, I am one of it.
Mohammed Shida, I'm still studying at the University of Administration, and we working on 3D website for British market.
إيهاب Journal Marketing at Unicam. Summit Hill. It's basically a virtual design with a quest. We're gonna make it like a game.
صلاح الدين web design on Zoom.
Zoom.
إبراهيم عنوان IT integration design machine and in the restaurant system.
I studied computer graphics and animation at Princess Umayya for Technology, and I currently work as graphic designer.
Nice. You're working on a startup or IDE or?
Yeah, with the team. So,
Okay, perfect. The first thing I wanted to, George. How are you? I gave a little assignment on to ask basically to think about about your valuation of your company. I know it's a very broad concept, but what I would like to do is if each group can discuss or present or whatever you want what you did and how you came up to it, so that and then we do the presentation and later Taylor and I will give you feedback on what you did based on also what we present here. So who wants to start with that assignment? Otherwise I think then Dori. Okay. You didn't do the assignment?
No.
Okay. Who did the assignment?
By saying the evaluation, should we mention only the value?
The value and what?
Or how did we start from scratch?
No, it's about because we are you're basically when an investor is talking to you because you're looking for money, you have to say my company is worth X,
Okay.
and then you have to give reasons why you do it. How did
Money
you?
issues.
That's not money issues.
Maybe it has to do more with the market share. No?
It has to do with market share. It has to do with money. It has to do with.
I don't know a lot about finance.
Any other one? Okay. I will just start and then we'll do it. We'll do it as we'll give a break and then we'll be. You can think about it again. All right. When you think about startups, entrepreneurial process, there are basically two things that are happening in a startup. First of all, you're going to identify if there is a need, what is the solution, and if there is an unfair advantage. By the way, if I talk too fast, stop me on. So the need is a market need, solution is how you solve that need, and the unfair advantage is basically your differentiator towards competitors or other people in the market. These three form the opportunity. But in order to get this opportunity, because investors look at an opportunity, so in order to get this opportunity, you need to get technology rights, things like software that you have to buy, other times you have to hire a team, and you need money to operate your business basically, because you have to pay salary to the people, for example. So these are your resources, so these are your costs, so your opportunity and your cost. When you talk about value, how do I create value? Because you saw that we're looking for the opportunity, you have a cost, but then what's the value? Well, technology can be a value. If you have something that nobody else did, if you have an idea and he is very smart, this creates value. So you create it by doing an idea and a concept, creating that value. People is a value as well. Because if we just said, okay, is it the market? Is it just the money? No, it's also how good of a team do you have? And then of course, there is money. Did you sell products or did you get finance? What is your financial structure today? Did you put money in the company yourself? Did you have a loan or do you generate revenue? These are all things that create value, especially in an early stage startup. If you then look at the cash flow or the money that comes in or goes out of a company, a typical graph is like this. In the beginning, you have the idea that didn't cost anything because you were thinking and you were maybe chatting with your friends, so there was no cost involved. But then, you think, okay, this is a very good idea and I want to really start working on it. You create a company. Well, first of all, you need to register the company, that costs money. Then you're probably going to hire people, a marketeer or a developer or something. So your cost will grow over time. Till you have basically the product ready. And then you still have to put cost because now you have to market the product, you have to maybe expand to other countries, things like that. So the cost will go. So this is all negative money in your or negative cash flow in your business. Until you go and really start selling and you grow and you get your customer base. So if you look at this, it's not only about this point. And because if you cannot cover this thing, it's also a time issue. How quickly can I do this? How much money do I need to do this? So when you start thinking about your company, these are things that you really have to keep in mind on how are you going to manage your money, but also how much am I going to give or spend? Because if you want to grow very fast, you can hire the best marketeer, you can hire but he will cost maybe $5,000 a month, and you cannot spend it because you don't have that money here. So technology entrepreneurship is not only innovation, it's also planning and budgeting and also how you're going to put it. The other important thing is when. If I do, some products have been invented, but they were just too early. For example, Philips did the Betamax video. I don't know if you remember that, but they were just too early because suddenly another company with VHS video, they came and they took the whole market. Well, Philips was much more innovative, but they got it. Apple is the other story. Apple had a very nice operating system. Windows got the market, right? Because they did something different. If you then look at the adoption life cycle, so this is basically when you get your customers and how much revenue are you going to generate. In the beginning, you have the early adopters, you have a few customers that are crazy, that buy something new that nobody has. Then you have what they call the early adopters, which then generate, but the bulk of the revenue is in the early majority, so when your product really hits and generates money. And then you have the late majority and people basically, the laggards. If you then combine those two together, so as a cash flow perspective on companies, so you have here your profit or your cash flow basically. Here you have your revenue or how you're going to sell. So this area is one of the most crucial areas in your company, because as soon as you hit this point, then your company will, until this happens, it's still a risky business. So planning that element is very, very critical. Now, I put some stages here. So for example, here, this is the entrepreneurial area where you have seed and angel investors. Well, here you have more the venture capital, and I'll go into that a little bit later. And here you have more the buyout stock options, like for example, Waze being bought by Google or Dropbox and all the did with IPO. These type of things are happening at that stage. We're talking in the early stage really at this element. So you're basically designing a product, creating a team. You need money to start that, and you need to get your critical mass of customers. So you're in a very, very critical stage that to really create the value. Because somebody said, okay, the value of the company is how much money I make. But today, most startups in the first year don't make money, or at least make less money than they spend. So that's what we have to keep in mind. Now, this is a bit of a long video, but I think it gives a very, very good feel on the video. Is it working? Because we talked about those things. We talked about opportunity, we talked about the resources, we talked about what's going on. So value is one. It's in early stage, it's not about money, it's about the team, it's about the ID. But most of the things, when we invest in a company that has a beta product, has no customers, we don't know what's going to happen. Right? As an investor, I'm investing in people. I want, if I'm talking to you or to you, you have to convince me, you have to let me feel that you know what you're doing, that you know the market, that you know the things. So value is very subjective, and it's the entrepreneur's role to convince the investor that his plan, his ideas, his calculations are the right ones. That's why I wanted to give this as a kind of an inspiration.
How do you explain when things don't go as we assume? Or better, how do you explain when others are able to achieve things that seem to defy all of the assumptions? For example, why is Apple so innovative? Year after year after year after year, they're more innovative than all their competition. And yet they're just a computer company. They're just like everyone else. They have the same access to the same talent, the same agencies, the same consultants, the same media. Then why is it that they seem to have something different? Why is it that Martin Luther King led the civil rights movement? He wasn't the only man who suffered in a pre-civil rights America, and he certainly wasn't the only great orator of the day. Why him? And why is it that the Wright brothers were able to figure out controlled powered manned flight when there were certainly other teams who were better qualified, better funded, and they didn't achieve powered manned flight? The Wright brothers beat them to it. There's something else at play here. About 3.5 years ago, I made a discovery. And this discovery profoundly changed my view on how I thought the world worked, and it even profoundly changed the way in which I operated it. As it turns out, there's a pattern. As it turns out, all the great and inspiring leaders and organizations in the world, whether it's Apple or Martin Luther King or the Wright brothers, they all think, act, and communicate the exact same way, and it's the complete opposite to everyone else. All I did was codify it. And it's probably the world's simplest idea. I call it the golden circle. Why, how, what? This little idea explains why some organizations and some leaders are able to inspire where others aren't. Let me define the terms really quickly. Every single person, every single organization on the planet knows what they do, 100%. Some know how they do it, whether you call it your differentiating value proposition or your proprietary process or your USP. But very, very few people or organizations know why they do what they do. And by why, I don't mean to make a profit. That's a result. It's always a result. By why, I mean what's your purpose? What's your cause? What's your belief? Why does your organization exist? Why do you get out of bed in the morning? And why should anyone care? Well, as a result, the way we think, the way we act, the way we communicate is from the outside in. It's obvious. We go from the clearest thing to the fuzziest thing. But the inspired leaders and the inspired organizations, regardless of their size, regardless of their industry, all think, act, and communicate from the inside out. Let me give you an example. I use Apple because they're easy to understand and everybody gets it. If Apple were like everyone else, a marketing message from them might sound like this. We make great computers. They're beautifully designed, simple to use, and user-friendly. Want to buy one? Meh. And that's how most of us communicate. That's how most marketing is done, that's how most sales is done, and that's how most of us communicate interpersonally. We say what we do, we say how we're different or how we're better, and we expect some sort of behavior or purchase of both, something like that. Here's our new law firm. We have the best lawyers with the biggest clients. We have, we always perform for our clients, do business with us. Here's our new car. It gets great gas mileage. It has, leather seats. Buy our car. But it's uninspiring. Here's how Apple actually communicates. Everything we do, we believe in challenging the status quo. We believe in thinking differently. The way we challenge the status quo is by making our products beautifully designed, simple to use, and user-friendly. We just happen to make great computers. Want to buy one? Totally different, right? You're ready to buy a computer from me. All I did was reverse the order of the information. What it proves to us is that people don't buy what you do, people buy why you do it. People don't buy what you do, they buy why you do it. This explains why every single person in this room is perfectly comfortable buying a computer from Apple. But we're also perfectly comfortable buying an MP3 player from Apple, or a phone from Apple, or a DVR from Apple. But as I said before, Apple's just a computer company. There's nothing that distinguishes them structurally from any of their competitors. Their competitors are all equally qualified to make all of these products. In fact, they tried. A few years ago, Gateway came out with flat-screen TVs. They're eminently qualified to make flat-screen TVs. They've been making flat-screen monitors for years. Nobody bought one. Dell came out with MP3 players and PDAs. And they make great quality products, and they can make perfectly well-designed products. And nobody bought one. In fact, talking about it now, we can't even imagine buying an MP3 player from Dell. Why would you buy an MP3 player from a computer company? But we do it every day. People don't buy what you do, they buy why you do it. The goal is not to do business with everybody who needs what you have. The goal is to do business with people who believe what you believe. Here's the best part. None of what I'm telling you is my opinion. It's all grounded in the tenets of biology, not psychology, biology. If you look at a cross-section of the human brain looking from the top down, what you see is the human brain is actually broken into three major components that correlate perfectly with the golden circle. Our newest brain, our Homo sapien brain, our neocortex, corresponds with the what level. The neocortex is responsible for all of our rational and analytical thought and language. The middle two sections make up our limbic brains, and our limbic brains are responsible for all of our feelings, like trust and loyalty. It's also responsible for all human behavior, all decision-making, and it has no capacity for language. In other words, when we communicate from the outside in, yes, people can understand vast amounts of complicated information like features and benefits and facts and figures. It just doesn't drive behavior. When we communicate from the inside out, we're talking directly to the part of the brain that controls behavior, and then we allow people to rationalize it with the tangible things we say and do. This is where gut decisions come from. You know, sometimes you can give somebody all the facts and your figures, and they say, I know what all the facts and details say, but it just doesn't feel right. Why would we use that verb? It doesn't feel right. Because the part of the brain that controls decision-making doesn't control language. And the best we can muster up is, I don't know, it just doesn't feel right. Or sometimes you say you're leading with your heart, or you're leading with your soul. Well, I hate to break it to you, those aren't other body parts controlling your behavior. It's all happening here in your limbic brain, the part of the brain that controls decision-making and not language. But if you don't know why you do what you do, and people respond to why you do what you do, then how would you ever get people to vote for you or buy something from you, or more importantly, be loyal and want to be a part of what it is that you do? Again, the goal is not just to sell people who need what you have, the goal is to sell to people who believe what you believe. The goal is not just to hire people who need a job, it's to hire people who believe what you believe. I always say that, you know, if you hire people just because they can do a job, they'll work for your money. But if you hire people who believe what you believe, they work for you with blood and sweat and tears. And nowhere else is there a better example of this than with the Wright brothers. Most people don't know about Samuel Pierpont Langley. And back in the early 20th century, the pursuit of powered man flight was like the .com of the day. Everybody was trying it. And Samuel Pierpont Langley had what we assume to be the recipe for success. I mean, even now, you ask people, why did your product or why did your company fail? And people always give you the same permutation of the same three things. Undercapitalized, the wrong people, bad market conditions. It's always the same three things. So let's explore that. Samuel Pierpont Langley was given $50,000 by the War Department to figure out this flying machine. Money was no problem. He held a seat at Harvard and worked at the Smithsonian and was extremely well connected. He knew all the big minds of the day. He hired the best minds money could find, and the market conditions were fantastic. The New York Times followed him around everywhere, and everyone was rooting for Langley. And how come we've never heard of Samuel Pierpont Langley? A few hundred miles away in Dayton, Ohio, Orville and Wilbur Wright. They had none of what we consider to be the recipe for success. They had no money. They paid for their dream with the proceeds from their bicycle shop. Not a single person on the Wright brothers team had a college education, not even Orville or Wilbur. And the New York Times followed them around nowhere. The difference was, Orville and Wilbur were driven by a cause, by a purpose, by a belief. They believed that if they could figure out this flying machine, it'll change the course of the world. Samuel Pierpont Langley was different. He wanted to be rich, and he wanted to be famous. He was in pursuit of the result. He was in pursuit of the riches. And lo and behold, look what happened. The people who believed in the Wright brothers' dream worked with them with blood and sweat and tears. The others just worked for the paycheck. And they tell stories of how every time the Wright brothers went out, they would have to take 5 sets of parts because that's how many times they would crash before they came in for supper. And eventually, on December 17th, 1903, the Wright brothers took flight. And no one was there to even experience it. We found out about it a few days later. And further proof that Langley was motivated by the wrong thing, the day the Wright brothers took flight, he quit. He could have said, that's an amendment. He wasn't first, he didn't get rich, he didn't get famous, so he quit. People don't buy what you do, they buy why you do it. And if you talk about what you believe, you will attract those who believe what you believe. Well, why is it important to attract those who believe what you believe? Something called the law of diffusion of innovation. And if you don't know the law, you definitely know the terminology. The first 2.5% of our population are our innovators. The next 13.5% of our population are our early adopters. The next 34% are your early majority, your late majority, and your laggards. The only reason these people buy touch-tone phones is because you can't buy rotary phones anymore. We all sit at various places at various times on the scale, but what the law of diffusion of innovation tells us is that if you want mass market success or mass market acceptance of an idea, you cannot have it until you achieve this tipping point between 15 and 18% market penetration, and then the system tips. And I love asking businesses, what's your conversion on new business? And they love to say, oh, it's about 10%, proudly. Well, you can trip over 10% of the customers. We all have about 10% who just get it. That's how we describe them, right? That's like that gut feeling, oh, they just get it. The problem is how do you find the ones that just get it before you're doing business with them versus the ones who don't get it. So it's this here, this little gap, that you have to close, as Geoffrey Moore calls it, crossing the chasm. Because you see, the early majority will not try something until someone else has tried it first. And these guys, the innovators and the early adopters, they're comfortable making those gut decisions. They're more comfortable making those intuitive decisions that are driven by what they believe about the world, and not just what product is available. These are the people who stood online for 6 hours to buy an iPhone when they first came out, when you could have just walked into the store the next week and bought one off the shelf. These are the people who spent $40,000 on flat screen TVs when they first came out, even though the technology was substandard. And by the way, they didn't do it because the technology was so great. They did it for themselves. It's because they wanted to be first. People don't buy what you do, they buy why you do it. And what you do simply proves what you believe. In fact, people who do the things that prove what they believe. The reason that person bought the iPhone in the first 6 hours, or stood in line for 6 hours, was because of what they believed about the world and how they wanted everybody to see them. They were first. People don't buy what you do, they buy why you do it. So let me give you a famous example, a famous failure and a famous success of the law of diffusion of innovation. First, the famous failure. It's a commercial example. As we said before a second ago, the recipe for success is money and the right people and the right marketing conditions, right? You should have success then. Look at TiVo. From the time TiVo came out about 8 or 9 years ago to this current day, they are the single highest quality product on the market. Hands down, there is no dispute. They were extremely well funded. Market conditions were fantastic. I mean, we use TiVo as a verb. I TiVo stuff on my piece of junk Time Warner DVR all the time. But TiVo is a commercial failure. They never made money. And when they went IPO, their stock was at about $30 or $40, then plummeted, and it's never traded above 10. In fact, I don't think it's even traded above 6, except for a couple of little spikes. Because you see, when TiVo launched their product, they told us all what they had. They said, we have a product that pauses live TV skips commercials, rewinds live TV, and memorizes your viewing habits without you even asking. And the cynical majority said, we don't believe you, we don't need it, we don't like it, you're scaring us. What if they had said, if you're the kind of person who likes to have total control over every aspect of your life, boy, do we have a product for you. It pauses live TV, skips commercials, memorizes your viewing habits, etc., etc. People don't buy what you do, they buy why you do it, and what you do simply serves as the proof of what you believe. Now let me give you a successful example of the law of diffusion of innovation. In the summer of 1963, 250,000 people showed up on the Mall in Washington to hear Dr. King speak. They sent out no invitations, and there was no website to check the date. How do you do that? Well, Dr. King wasn't the only man in America who was a great orator. He wasn't the only man in America who suffered in a pre-civil rights America. In fact, some of his ideas were bad, but he had a gift. He didn't go around telling people what needed to change in America. He went around and told people what he believed. I believe, I believe, I believe, he told people. And people who believed what he believed took his cause and they made it their own, and they told people. And some of those people created structures to get the word out to even more people. And lo and behold, 250,000 people showed up on the right day, on the right time, to hear him speak. How many of them showed up for him? 0. They showed up for themselves. It's what they believed about America that got them to travel on a bus for 8 hours to stand in the sun in Washington in the middle of August. It's what they believed, and it wasn't about black versus white. 25% of the audience was white. Dr. King believed that there are 2 types of laws in this world, those that are made by a higher authority and those that are made by man. And not until all the laws that are made by man are consistent with the laws that are made by the higher authority will we live in a just world. It just so happens that the civil rights movement was the perfect thing to help him bring his cause to life.
I'll stop it here because it takes a long. But the main message that comes out here is the sentence that he says, you have to believe in what you believe. Because it will not only help you with your company, it will help you get the right people in your company. And it will also get you the right people that are not going for the salary, because they will believe in what you believe. So they are going in the same cause. It will help you get customers. But it also will get you investors. Because again, getting money from investors is convincing them to believe in what you do. So it's very important that you start thinking about your company. Because when we did the introductions, for example, I have an online bookstore. So what? I have a game. So, right? So you have to really, when you go and talk to customers, to hire people, to get an investor, you have to convince them that what you do is one, you believe in it, you want to make him believe or her believe in it, and you want him to see or her to see that this is something that you can get for it.
In this graph, I want to ask a question. He said 2.5 for
Innovators.
And 13.5 and these sections. How should I do? I reach or I complete the first 16% of the mark?
By convincing people to want your product. Right.
Because in this graph he said there's a gap between.
No, what he's saying, you can only convince the majority of people to buy your product if you convince those people. Because those people are the easier ones to convince. Because they make gut decisions, they make decisions not rational. When you're buying a flat screen TV for $40,000, it's not a rational decision. It's because they want to be the first, or they want to be an innovator, or they want to have an image. I mean, why would people buy an iPhone to show, look, I have the newest gadget? because that's part of their,
Loyalty.
or no, but also their identity. So, again, and so if you don't cross this line, you will stay, you will not make this growth enough. This is what he's trying to say, but this is a general marketing and business graph. So, but what he's adding to it is this story about you have to talk about the why. You have to touch the people where they make decisions, and it makes them. So it's very important for an entrepreneur who wants to start a company that he believes in what he's doing. That he's not just doing something, because that will not convince investors to invest in. And that's why it's very relevant to think about this and to think also about what you're doing. Because I'll give you an example. I think you all know WebTech. WebTech is being started by Mahmoud. Mahmoud was a doctor. He did his school, his everything. He had a practice. He had a good job. But he could have a very good life by being just a doctor. Because he believed that there was a big need for information to be spread to more people than just going to doctors. And this is why he did what he did. This is why he is successful. This is why he got investors. This is why, because also if you hear him talking, I was in a panel with him a few weeks ago. You just listen to him because he is so into it. He is so into what he's doing that you believe what he's saying, everything he's saying. Maybe he's saying things very wrong, but when I listen to him, I believe him, and I want to invest in it. More questions? This was the introduction. Because I want you to, again, I want you to think differently. I want you to think in another way. Now we go into the more basic definitions and stuff like that. Because if we're looking at investment, there are different types of money that you can get, or different types of investment sources or money sources. And we have the 3 Fs, which is basically the fools, the family, and the friends. Those are your early people, or it's your own money, for example, bootstrapping. But
It's again, what's the...
fools, friends, and family. So basically, you want to start a company, you go, hey dad, can you give me some money because I want to start this? Or you do it with friends, you put your friends in there. Then there are grants, we're very familiar with that, grants from NGOs, and basically that's free money. Bootstrapping is, there's a guy in the UAE, he's a Yemeni guy who started a company. And he had no money, and UAE is expensive. So he has a garage office, a bit like Apple, he had a garage office. He's living there, he's working there, his team is sleeping there. So this is how he manages to reduce his cost and to make his company go forward. Also that, when he's telling you this story, for me as an investor, it shows that he believes in what he believes. Because he's ready to, live a miserable life to make sure his company is going to be successful. Then you have what we call business angels. Business angels are individuals that either they are ex-entrepreneurs, so people who sold their company, made a lot of money, and they want to do something again in startups, so they invest in companies. So the thing with business angels is also they are not only money providers, they're also advisors, they're mentors. They will be helping you in starting your company. Then you have the institutional VCs and private equity. And for example, VC in Palestine is Sadara, the private equity is Siraj, if you ever heard about that. And they basically are a pool of money that are being, so a number of investors put money in a fund, and then that's what we call a VC fund, and that fund is investing on behalf of those investors in companies. Then the other one is you can sell your company, so you get money. You can merge with another company to get money. You can go to the stock market to get money as well. And you can get bank loans. So, if we're going to then to valuation, general definition of a business valuation is basically estimating the fair market value of a business entity. And a fair market value is defined as the value that a willing seller and a willing buyer, both being informed of the relevant facts about the company, could reasonably conduct a buy-sell transaction, neither party under any compulsion to do so. Think about it in this way. I have a house, and I want to sell it. Right? I love my house. I think my house is $1 million. And then he's coming to me, I want to buy it. But he says, it's here in the street in the park, why would I pay $1 million? I'll offer you 200,000. What's the value of my house? Now, what's the value of my house? Nobody knows. It's somewhere in between. Because the value is only the value if he's willing to pay me the money I want for it, and I'm willing to sell the house for the money I want for it. So if we agree, then you have a value. And that's the same for companies. And that's why you have to convince your investor that the value that you have is the value that he is willing to pay for it. So it's always, it's coming together. Why do you need a business valuation? And one is of course the investment, or to get a loan is another reason why you want a value. Because if you go to a bank and you want a loan, then the bank wants to know what's the value of your company, because they want to have something against their loan. It's important when you want to do a merger, you want to sell your company.
Sorry.
Yes.
No, actually I didn't get the last part. Actually, I need to know what is the value. Okay, if you're willing to pay for 1 million and he's willing to pay 200, okay, there's a big gap, whatever the gap is.
Yes.
Okay, how we can get to the point that you are willing and he's willing?
Okay, how do I sell my 1 million house?
Okay, right.
I go to him, he's 200. I go to him, he says, maybe 300.
Right.
Do I need to get the money?
Yeah.
If I need the money, I probably sell it for 300 and the value was 300. If I don't need the money, I say, wait till I get somebody maybe 900.
Okay.
So if you found a buyer who's willing, who actually needs your house cost $1 million, you'll just give it.
Exactly. Because if somebody is in my house, he will pay more than the 1 million.
You'll have to get who believes in your idea, actually. Who believes?
2 weeks ago, I sold my own house.
That's why
Not for $1 million, but I put it for sale, and suddenly 25 people came to see it. So I put a value that I wanted to get the house for. And the people paid more than I was asking, because one of the 25 wanted it before the other. So the value was more than I thought it was. Right? So what I'm trying to say with this is, value is subjective. Value is subjective. So value is not something that you can pinpoint. It's what you're willing to give and what somebody is willing to give. So you need evaluation for investment. You need evaluation if you want to buy a company or you want to sell your company. If your company goes bankrupt, there is also something that you need evaluation for, because assets need to be sold, things like that. If you have a dispute, in a legal case, somebody's suing you. For stock option incentive, if you want to give your employees stock options, you need to know what's the value of the stock option, because you want to give an incentive to your employees, for example. But also for more nasty things like taxes, insurance, and of course financial reporting. So valuation is not only important for investment, but for a lot of other things. So that's why it's good to think about it. So what's value? Again, it depends on the perspective, motivation, and the situation. It depends on the seller, it depends on the buyer, it depends on the investor, it depends on the government. And if you have a government, it's very difficult, a lot of regulations, and the risk is higher, so somebody is not willing to pay a lot of money for it, for example. It also depends on salary levels, cost levels. It's the same as my house. If my house is in a beautiful mountain with free view, or it's here in the same house here in an industry park, it's a different value. So, a very good assumption is at the beginning the value of your company is 0. When you're very profitable, it's a lot of money. Anything in between is up for negotiation. So now we're looking at the value of early stage high-tech companies. So this is very important that it's for early stage, so you're not making profit, you're not having a lot of revenue, you're not having a lot of things, and you're looking into technology. So valuing high-tech ventures is very difficult. Some of the issues, what is the risk of technology? How quickly can somebody else do something? For example, there is a company that was thinking to do Facebook search. Because there's no search on Facebook on text. There you can search for friends, you can search for pictures, you can search for companies, but you cannot search, for example, on a comment. So he wanted to do that. And for me, it's very risky.
I think they already did it. I read something about it today.
Okay.
They updated the search engine on Facebook.
But that's the thing, because if he pops up and Facebook sees it as a threat, they have a zillion developers that can, in 2 seconds, do the same thing, and he's out of business. Right. So these are things that, as an investor, you look at. You look at market risk. So how many customers do you think will buy it? And for example, if you want to do a program in Papiamento, which very little people speak, the volume is low. If you do it in Arabic, you have 450 million people that speak Arabic, so that's the difference. The other thing is looking at how many competitors are there. Right? The other issue is there's no sales, so you have no proof of results. Of course, valuation changes by time. I mean, it depends on market conditions, it depends on regulation. And for example, valuations of company during Gaza war will be less than valuations after Gaza war, or if there is a peace agreement, or is there, things like that. So the political situation takes time. There is no proven formula, and the buyer and the seller may have different approach to value. Like I thought my uncle, he thought it's just 200, so there's a difference in how we look at it. So, what's the business worth? First of all, basically the value you determine on a hypothetical sale. So for how much do you think you can sell a company is the value. If you go to a bank, for example, a bank looks at assets. What's an asset? For example, if you have a building, if you have machinery, if you have a patent, those are assets, so they can put a number to it because banks just like to calculate. Right? So they're doing it that way. So you're selling like you do a house, but the problem is you have tangible assets, or real assets like a machine or a computer, a chair. But you have intangible assets, which is your ID, your innovation, your the way you structure your business, the people that you have in your business. And I was talking to he's a Palestinian, Sami Shalabi. He's working at Google. He had a company, and his company was bought by Google. And he said the first thing that Google did to buy my company is to interview every single employee I had in my company. Because for Google, it's very important to have very good engineers. If the company has no engineers, they will not buy it. If they don't like the employees that are in the company, they will not buy it. So that was for them a very, very important asset. So and then again, you need to explain and justify your value. You have to be able to explain why your company has the value that you think it has. And you have to come with facts and numbers, but also convince the investor about the value. And that's why in the beginning I gave you the assignment on what's the value, because you need to really explain and justify what your value is. Now we come into the more technical side. There are 4 ways of doing valuation. The first one is the market approach. This is what I'm just discussing the whole time. You know, I have my house for $1 million, and he wants to offer it. So that's market-based. So I'm going to look at what's a similar house worth in my neighborhood. Then probably I have to have something the same. So you have to look at my company. What did my company that is a bit similar to my company get as an investment or get as a valuation? So this is market approach. Then you have the cost and asset approach, but then you have to have a record. Usually they look at a 5-year period that you have revenues and costs. And then based on that, they calculate the value of the company. Price to earning ratio and the income approach. So when, for example, a big company wants to merge or buy another company, they look at their balance sheet, they look at their finances, and they say, okay, if you make 100 million profit, then the value of the company is 5 times that profit, or 10 times that profit. So the value is 1 million. Right, so that's more, but all these number 2, 3, and 4 are not applicable for early stage technology startups, because one, you have no, you don't have assets, you don't have revenue, and you don't have, you have costs, but so what's the market approach? I think we discussed most of it, based on economic principles, supply and demand, valued by comparable transactions. You have to look at what do other startups get, who are in the same stage with a similar type of team. And what are other similar businesses whose value has been recently established? And of course, what's similar?
Third point.
Yes?
Third point again, please.
Third point. What are other similar businesses who have recently, so let's say today you have a gaming company, you are at the same stage as the guys that do the book side. You get a valuation of 100,000. And you have a recent established market set, so you are setting the stage. So then he can argue that, okay, they got this, they are similar to us, so this is our value. It's the same as, again, selling a house.
Yeah.
You look, your neighbor sold his house for 500,000, so I cannot sell it for 5 million. Because the value is something similar to what has been done in the market before. Unless I put a very nice bathroom and a very nice kitchen, and I can argue that. So how do you create value for your startup? First of all, idea and vision. Idea and vision are crucial. Because again, as the video said, you have to believe in your vision, you have to believe in your idea. So you have to believe in what you believe. So this is here. Your concept, so how are you going to implement this idea and vision? Who is your team? What is your market segment? So what is your addressable market? Where you want to sell it to? The stage of the company. So where are you in the stage? Do you have an idea? Do you have a product? Do you have do you already have customers? Are you in multiple countries? These are all things that are creating extra value. And then of course, what is very important, the next milestone. So I'm going to an investor and I say I need $100,000 for the next year to go from a beta product to a general available market product with my first customer. So this is what an investor looks at, because he can assess based on that milestone what will happen in the next stages. I think that the first article that I sent in the email is talking about especially this part. So, if we put all that we discussed now into this sheet, we're talking about investment decisions. So first of all, you're talking about market attractiveness. So you need to talk about the size of the market. You need to talk about how is the market growing, and what is the expected market share that you have. Then you have your financial plan. So what is your cash flow? So what is your expected cash flow? What is your expected funding needs? And what this means, capital intensity, is what is your burn rate, as they say it. How much do you spend per month in your company on salaries, on rent, on this? Because then I can calculate how long you can do. So if your burn rate is 10,000 a month, then with 100,000 you can run for 10 months. You say to me, give me 100,000, your burn rate is 10K, and you say I need this for a year. I know you didn't do your homework.
What's the debt capacity?
Sorry?
Debt capacity.
Debt capacity?
Yeah.
Debt capacity is, because this is a sheet for not only early stage startup. If you have assets, you can take a loan.
Okay.
Right? So based on this, you get basically an expected profitability. So this is the positive element of an investment decision. Because on the other side, there is risk that the investor is looking at. One is what are the management skills of the startup. Right? That's why I said it's very important. The first thing that I look at is who is the team? Are they capable? Do I believe that they can do what they're saying they're doing? What is their expertise? And I'm a good example. If I would go to an investor and say, I studied physics, but I have a marketing product, do you believe me? But I have a track record now. So now they believe me, but if I just say I studied physics and I want to do a marketing product, they don't believe me. So what's the expertise? How flexible are the startups? How flexible are the people? And of course, track record. So for example, if you did a successful startup before, and you sold that startup for 10 million or whatever, your value will be higher. Because, the investor will see, he did it before, so he knows how to do it again. And then, of course, the competitive advantages are the other risks. So what are the entry barriers? And what are the problems to market? What do you need to overcome? Time to market. How quickly can you be to market? Like, for example, the Facebook example that I said, if I do a Facebook search, can Facebook do it quicker than I can? Then that's a risk. But if I already have it and I launch it and I can get a lot of customers, then my time to market is an advantage. Exclusivity contracts. And if you have specific contracts with big customers, for example, if you have a mobile app and you sold it to Joel already, that's an exclusive contract that will reduce the risk. Distribution control and control of your supply chain. So these are more technical sides. So how do you buy stuff, and also how do you sell stuff? How do you use distribution? And then so these two together form the investment decision. So how good is the opportunity? How much risk is it? So now how do we increase the value of the business? This is a very, very, very important slide. Because at the beginning of your startup, you have a low value, right? And you increase the value by reaching milestones. First you have the ID, then you have a beta product. Okay, this is a beta product. You have a general available product with first customers. Then you go from Palestine to selling the GCC. Then you go global. These are steps that increase the value. Now, if you're applying for investment, if you ask, for example, a $1 million in this stage, and your value of your company is $2 million, then you have to give 50% of your company. If the value of the company here is 10 million and you want the 1 million, then it's only 10% of your company. Right? So these are very important steps. So in the beginning, you ask for low amounts of money, and then in order to increase that value, then you go for a bigger amount, and then you go for a bigger amount, and then you go for a bigger amount. So you have to plan that very, very carefully. Never ask too much money. Always try to see how can I reach my next milestone with the minimum amount of money, and that's what I'm asking for. Because at the end of the day, investment is very expensive. Because if you lose 50% of your company at a value of $1 million, then here you have almost nothing left. Right? So you want to keep the percentages low, and make the steps to increase the value of your company. These are just example steps. You know, I took other examples. And then you can do value steps in different things. So you have here concept, feasibility, patent, working prototype, market introduction, other milestones. This is on the technology side, but you have it also on the people side. This is on the market side. So doing a market analysis is something that adds value. We're doing quantitative research, doing surveys, beta test, market launch, segmentation, expansion, geography. These are all steps that, and then if you go to team, it's the same thing. So here first you have only technology, then you add a marketing guy, then you add a vice president, whatever. You know, so you grow your team, which creates value as well. And this was a funny one. So this guy invented this wheel. He said, but so far he couldn't affect anybody because he couldn't convince that this is wrong. Right? So there are multiple stages, as we just said. You saw the value creation, and then there are multiple stages. The first stage is, so you have the concept, then you go to what we call seed. This is more a terminology side. Seed investment. So that's basically capital for product development, market research, and rebuilding the management infrastructure. Then you go to what we call first stage or VC type of things. This is to scale your business, to either go to different markets or to increase production or to grow that. And then you have the bridge stage is to maintain businesses. So there are multiple levels. For example, I don't know if you heard about Uber, the taxi company. They recently got, I think, something like 25 billion in investment because they wanted to expand globally. Right, but they had investment stages before it. Same with Mark II, the documentation. So they had a seed. First they paid everything themselves. Then they had a seed investor. Then they had a VC investor. And then they had another private equity company. And then they were bought by Yahoo. So there are multiple stages where they created value.
What's the meaning of IPO?
IPO is when you go to the stock market. So it's a public offering or public offering. So when you go to NASDAQ or to the Palestinian Stock Exchange, so you basically offer the shares to the market.
الاكتتاب الأول.
شركة مساهمة عامة.
This is a similar slide but differently. So in the ID stage and the feasibility side, you're talking to the founders themselves, the friends, family, and fools to come with a concept. If you go from feasibility to government prototyping, you're talking about grants, but also you're talking to business angels, seed type of investments. If you're going to more the commercialization, you have VC, real sales, and backlogs. Because here when you have commercialization, you have assets, you have revenue, so you can go to the bank. Initially, the bank will not give you the money because you have nothing. So they are so risk averse that they will never provide this type of money. Again, you always have to think, do I really need money? Because if you have money, or if you can keep the cost low, it's better to grow your company, to increase value by going into business, rather than to get money. So so you need to always think how much money does it need. And if you want to build a factory, of course you need money. If you build a website, you can think, I can do the initial beta by myself at home next to my work. I keep working. Another important, how fast do you want to grow? I mean, for some things you need to grow extremely fast, so you want money to run because there's competition, there's things like that. Also, how much risk are you willing to take? And how much control do you want to give up? Because if you go to an investor and he invests, he's getting shares in your company, so he has decision rights as well. So you cannot make decisions on your own. So if you are somebody that doesn't want any influence of anybody in the company, don't get president. but then you probably cannot grow fast, and you might have missing other stuff like support, connections. So what are the pros? First, the pros of external money is to enable business to become into existence. Because if you don't have money and you need to register a company, you need to buy stuff, you get that. You can enable the business to grow faster. And plus, you know, it's not your own money. And if an investor gives you 100,000, it's not your money, so you can spend it in a way, it's less risk for you. On the other hand, investors want a share of your business. You want a share of your profit, and also they want a kind of a control over your business. So these are the things that you need to weigh against each other. So, of course, your money is quite precious. I mean, putting your own money all the time is affecting you on other things. The friends, fools, and money. Friends and family money is often very expensive, and so you have to give a lot of equity shares for that type of money. Angel money brings angels, and you know what we mean by it, they also bring connections, they bring network, they bring advice, they bring. So that can be a plus. Seed funds are often hard to find these days, but they're coming up. And of course, VC money is what they call rocket fuel. You can talk to Taylor because that's the big amount of money to really start growing very fast. I don't know what's your minimum ticket size?
We target 1 million.
1 million. So, and in order to get a VC investment, you're looking at a 1 million investment. So you really, you know, with $1 million you can do a lot. But you need to get there first to be able, because if you get $1 million investment, your value should be a minimum of 2 million to get 50%, to keep 50% of your company. So now I want to tell a bit what investors are looking for, because it's very important when you talk to investors to know what they want. Well, first of all, they want their money back at the end of the day. An investment money, if I invest money in a company, I put money in a company as an investor, I get shares. The money, if the company goes bankrupt, money is gone. And I cannot go to the entrepreneur and say, pay me back now. I put the money in the company is bankrupt, money gone. Right, so it's a risk. So what he's looking for, the investor wants his money back. And actually he wants a lot of more money in addition. He wants to make a profit on the money he puts into your company. Also, he wants to understand when they will get their money back. So how quickly will you grow? How quickly will you grow your value? He wants to understand what the risks are involved. He wants to understand that you know what the risks are. And also what your plans are to reduce that risk. He wants you to know how to get the product to market. He wants, so again, all these things are, you have to be able to explain and convince him that the investor believes in what you believe, right? He wants to know how to get the product to market. He wants to have clarity on how much money you want. And that's why you need to know how much money you need for your next milestone, because he's looking at that next milestone as the next investor coming in, and he can make a profit on it. Clarity on what you're going to do to use the money. So what are you going to use it for? Are you going to use it to buy a very nice office with very nice chairs, or are you going to do that to get the best engineers? It's very important to understand. And also, for example, when I look at it at a sheet, I look at how much salary do they put? How much salary do they put for their employees? Because that gives me a sign, are they in there to get a salary, or do they believe in what they believe? Because if they believe in what they believe, they are going for it because they see the bigger picture at the end. Also, we want to understand as an investor that the money that we're giving is enough to do what you promise us to do. Of course, reporting, and they need a mechanism to intervene. So, I mean, as an investor, if I see that things are going the wrong direction, I want to be able to intervene, to say, hey, stop, we need to change this. That can be as a board meeting or a board meeting. Because if you look at, and people argue this, that this is too high. But if you look at in general, if these are all the startups that get investment, out of those startups, 20 to 30% will go bankrupt. 50% will probably give their money back. So only 18% of the companies that get VC investment will bring more money than the investor puts in. So the investor is looking at these companies because this is how he makes his money. So and that's also why when for example, we as an entrepreneur, we have invested in 10 companies. I put most of my time in supporting the ones that I believe are here. Right? Because that's what brings us money back. I'll just get this one time for this. So you remember this graph again. So here you have seed, angels, friends, fools, and family. And here you have the VC side. So and this is again, when you have positive revenue, you're looking at VC type of investment. Okay. Shall we take a short break? Because now we're going into more calculative stuff to understand what it is. If there are any questions, feel free. There are teams, right? So can you, as a team, you want to sit together? And then come up with a few, maybe a 1 minute discussion afterwards, after I give you 5 to 10 minutes, to discuss what is the value of your company. And what are the value elements of your company. So you have to try to convince me. And actually we're going to ask Taylor also, because Taylor is an investor as well. And then we're going to give our opinion on the valuation. And so if you can go back to the teams and just discuss that, different points why we should invest and what is the value of your company and why.
Should we use it as a slides or just?
No, just
Yeah, just
So,
our idea is nice.
do we have studies? For a VC, you can talk? This is What are you doing? Are you dancing? I don't know what you're saying. I mean, you just do this. You dancing?
No, I was trying to add my.
Because I'm very adjusted to the society, so I know like this is not this.
Oh, sorry.
Yeah, I'm ready. Oh.
Yeah, Taylor, you're really elaborate here.
Because they told us. Okay, guys, let's start. Because you have here in front of you two investors. There's Taylor and there's me. And we're both going to evaluate.
Hey guys.
You know what?
We're going to evaluate your company. So you're basically trying to get investment from Taylor and you're going to try to get investment from by saying what you're saying. Who wants to start? Who wants to start? Start?
No.
Go for it. Come on, let's do it. Yeah. Who's pitching? Okay. Action.
We are creating a commenting and rating platform to help store owners or by focusing on restaurant owners to increase revenue, depending on commenting and reviewing and rating their business. What we will do is make a restaurant owners increase their revenue by this application. This application will make them rate and review inside the restaurant, and this for restaurant owners and for the customers. If you review more and if you visit the restaurant more, you will get a free meal or free drink. The current team, we have a marketing, web developer, and system analysis. We are three in our team. The market segment, we will start in Ramallah restaurant, and then we'll cover all the West Bank. And we are now still in analysis phase, which is we draw it in seed level. And that's it.
What do you think the value is of the company?
The value, yeah.
What do you think the value, the number? How much are
ليش
you?
بتطلع
What's the?
ليش بتقيم الشركة؟
Actually, there's in West Bank, there's about, or in Ramallah, there's about 600 restaurants. And we focus to get most of them in Ramallah first. When we succeed, we will go to
No, but I'm meaning, so what is the value of your company? Is it 100,000?
The initial stage.
At this moment.
Then she's this one.
He's trying to get investment from us.
Yeah.
Right. So what do you think is the value of your company?
For restaurant owners, what they are looking for is to increase their revenue.
What I mean is,
قديش
you're looking for investment of.
قديش بدك استثمار مالي؟ قديش تضيف؟
قديش بدك اياه؟
لا
You mean money?
Yes.
That's
لا مقارنة.
How much money do you want? About?
actually maybe 10 to 20.
Okay.
And what percent of the company will you give us for $10,000?
I think there's good to create the stuff, to create the website and the application. First place.
But how much are you willing to give away? 10%, 20%, 50% of the company? And in other words, is the value of your company, if you say, I want 10,000 and I give you 10%, then the value of your company is 100,000, right?
Yeah. Numbers.
So let's say, so it's important to understand now, if we
Yeah.
give you $10,000
Yes.
and then you give us 10% of your company, then the value of your company was $100,000. If you give us 20% of your company, then the value of your company is $50,000.
Yeah, I understand, but I don't have numbers.
Okay, that's fine. That's fine.
even people who work on this for years don't know the value of their company,
Yeah.
so it's fine.
Yeah. Next, we're not going to give number, we do it at the end.
Okay, the whole idea came up that we have a huge number of students and people are not willing to pay a lot of money on their textbooks.
To buy an original
To buy
book.
an original textbook, since they are not going to use it maybe after they finish their studying. So we established a Find a Book website. We call it Find a Book. It's very easy to find. And we offer a used original textbook that the seller, same as the buyer student, who he did buy an original book, so we can offer it on our website, and another students can buy it. So that's our idea. So we help students to find used textbook, and also limited income people can offer it. It's
To buy it.
affordable for them. Can I have a book? I'm sorry. We have a great team. We have a designer, marketing, sale.
Online marketing,
It's an online marketing.
financial.
We have a huge market segment. It's renewable. Each semester we have new students. So we made a study. It was
In Palestine, we have about 230,000 students after the secondary schools. Our expansion for the MENA region will be our target about 7,500,000 students in the 22 countries. Our stage now in the initial stage, we are still in the concept stage. Our next milestone will be, yeah? Oh, okay.
The next milestone, it's like, it would be now since we have the idea, we're just trying to develop the website and to settle on how would we get the idea out to students. Like, okay, we will expand to the Middle East, but we're starting in Palestine, and in Palestine, for instance, if you like, we're talking about an online business now. If you want to sell books or buy books online, how many, like, what's the percentage of the people that are going to actually use the online transactions? Whereas you only have 4 to 6% of the people having an online shopping cart, for instance. So, yeah, building the website and finding the solution for the payments and all the transactions that are going to happen online is our next milestone. But we believe that the idea itself is worth it because it's very convenient for students to have like affordable used books to buy, and we believe it will be like good if we work on it. The value, the value.
Customers, percentage of customers that we are targeting. We said, or we discussed that last time, that maybe our customers will be about 25% of the students. So the revenue for each semester of annual revenue for us, it will be
minimum.
the minimum of 2,000 students per year, with minimum purchase about 200 shekels. So if our revenue would be about 7 to 10%, so at the end of the year we have a very big market share and revenue.
How much are you looking for?
So we are looking for about to start $50,000, and we are willing to pay to give 7 to 10%.
All right. Thank you. Next.
that our project will give our customers satisfaction between knowledge and entertainment. We are working on a project that will make them able to have a quest by entertaining a game. At the same time, it will be in Asian places in the whole world. It will be virtually 3D and augmented reality. Our segment is huge of youth, so they will be able to pay for money for the quest or pay for money to gain coins. We estimate that we will have 70 visitors to the game in the first 6 months for each day. 50 of them will be active. We are roughly talking about revenue between 3,000 a month, which means in the first 6 months we're talking about $20,000, roughly $20,000 for the first 6 months. Our cost, cost is much higher, but we are looking in the long run. It will be very profitable. Project cost, project value will be $1 million. We are seeking investment of 50%, 15%, with 150 million dollar.
150K.
1,000.